But
so aren't you just a private investor who's taking some pain?
Well, the question in Credit Suisse is was Credit Suisse failing? I mean, we're talking about a bank, who had 14.7, I think, percent of CET1. A liquidity coverage ratio, after all the deposit redemptions at around 144%. So, much higher than, for example, the average US bank. And you had the FINMA saying that the bank is not insolvent. So, I mean, I'm happy to say, when a bank, fails, then of course you proceed to the wind down of the bank, and of course you apply the hierarchy of claims. And when the equity holders are wiped out, then you move to the bondholders. That's what happens. But here we're talking about a bank which failed between bracket with 14-point-something% of CET1, yeah. And full of liquidity.
So we have to take at face value that the deposit flight was significant enough towards the end of last week that the authorities had to move in, or they felt they had to move in very quickly to stabilise the situation. Otherwise, the outcome could ultimately be worse. Let's take it as read that it was failing and it needed this action taken. Do you think the decision that was made to allow some of the equity holders to get capital and you to not get capital was politically motivated by the anchor shareholders in that bank? The fact that it was Middle Eastern money, which we know is very important these days to the asset management industry in Switzerland.
Most likely. That's the only logical explanation. But I think the decision is still very bad. The additional tier one really are a key pillar of the capital stack of banks. It's a full important part of the Basel III agreement, and that means that you can't trust anymore the capital stack of a bank. So that's why I think it was absolutely key for the European authorities and the UK authorities to yesterday came out reassuring investors on the fact that in the UK and in the EU the capital stack would be respected and the hierarchy of claims would be respected in case of a bank failure. I think that's absolutely key.
David, can we get into what it said on the tin around these CoCos? The yield was much higher than other AT1s and other bonds, so the yield close to 10% in some instances. In terms of what it said, there was a clause that if there was a viability event, that these bonds could be written down to nothing. Some would argue that the viability event was the intervention by Swiss authorities to backstop the new entity, the huge liquidity provisions that have been provided. What would you say about these two things, that the yield reflected the risk, and number two, that there was a clause there?
Well, the yield reflected some risk, I would say. Over the last day, of course, it reflected clearly a risk of failure and non-viability. That's true. Then when it comes down to the small print of the prospectus, in reality, they changed the law on Sunday to enable the FINMA to write down properly the AT1 without any constraint. So, of course, there's a degree of flexibility in the prospectuses. But if they change the law on Sunday, it's because they didn't have enough flexibility to write down the AT1s to zero, obviously.